Hello and welcome, dear investors. We are live now. Hi, chat. I put you on the pictures.
Hello.
Hi. Last time we talked about dividend graveyards, our biggest fails. Not all of our fails, but at least some of our fails, right, chat?
Yes.
Talking about all of our
biggest
chat.
disappointments.
Talking about all of our fails would have been much too long. Then we would still talk about it. It would have taken the whole week maybe. But we also have some success stories, and we want to present these to you and show you the power of dividend investing this way by real world examples. And both Chad and me, yes, Chad, you brief, you want to say something?
Well, the nice thing is that since I've changed over my strategy from high dividend hunt to total growth, I've had a lot of success, and I'm just going to highlight the top ones.
Yeah, we both are only going to share some of these stocks to you. And then finally, we will ask you to throw some names of us, of your dividend success stories, and then we can look at these on Dividend Stocks Cash. So
and
my name is
doing that now. You can start posting in the comments, what are your biggest successes now while we're presenting ours?
Yeah, exactly. So, Chad, you are still sitting in Seattle, I guess?
Yep.
Want to present yourself in 1, 2, 3 phrases?
Sure. My name is Chad Lupkes. I'm in Seattle, Washington, USA, and I started investing in the summer of 2000, and I spent 10 years throwing darts, as I put it, hoping that the ones that it landed on would do well. And then I spent about another decade on a high dividend hunt, trying to find the highest dividend yield that I could find. And I did not have a lot of success with that. I thought I was, but then everything crashed and I learned my lesson. Now I'm focused on finding total growth, looking at both dividend growth and price growth, and trying to find those companies that will be able to maintain that growth going forward into the rest of the century. So that's basic introduction on what total growth investing is and why I started this channel, because with so many people joining the markets for the first time because they're stuck at home, not able to do much else, a lot of people are making foolish decisions, and I just want to try and teach some lessons that I learned the hard way before people lose a lot of money.
Okay, thank you. And I am Thorsten. I'm sitting in Germany, close to Frankfurt, and I am throwing fundamental data at you. I was also throwing some darts, but now I'm throwing a lot of fundamental data on your screen. I'm the founder of Dividend Stocks Cash or Aktienfinder.net, both in German and English available. Okay, so maybe before we are going to talk about our dividend success stories, let's talk a little bit about the highlights of the last week. And I guess the audience knows what it's about. It's about Tesla and Apple. Apple is the first company which passed a 2 billion market cap. It's not a long time ago, Chad, that there was a race for the first company exceeding 1 billion market capitalization. Do you remember? Just
so
yeah, Apple, like that.
Apple passed 2 trillion.
2 trillion, yeah,
that's trillion.
That's a problem with the German. Until million, anything fits, but starting in Milliarden in Germany, it becomes billion, and billion in Germany is trillion in English. So it's a confusing thing. I don't know what something in the human history went terribly wrong, at least with these numbers.
Well, yeah. So Apple passed $2 trillion this week, and you're right. It feels like just a few months ago they were competing with Microsoft and Amazon on which one of those three would pass the $1 trillion mark. and now they're at 2, and the others are following close behind thanks to the incredible rise in prices that we've seen.
Maybe I can share my screen and show here the whole picture of Apple, because it's really incredible. The symbol of Apple is why don't I see it?
AAPL.
Yeah, okay, AAPL. I switched to the name, that's easier. Yes, you're right, AAPL. So, and if you look at here at the chart, you really see this incredible story. So the stock went up from starting 2019, and that's not 2 years ago, but only 1.5 years, and we already made total yield of the stock price more than doubled.
Something important to see on this graph. A lot of graphs that you look at like this on other websites, their scale they will start at 100 if they're looking at 200. With Torsten's site, it starts at 0 down at the bottom on the bottom left.
You mean that?
Yes.
Yeah.
A lot of websites, they will start at 100 if you're, to be able to show more detail, but that's not a fair representation of just how much this stock has gone up over the last year or 2 years. Looking at it with a full scale from 0 all the way up to 600, that's the only way to get a fair look at what this value has done.
And you can also switch to logarithmic.
Yep.
So it's really an incredible story. And unfortunately, I don't own so many Apple shares. I own, I don't know. I can say for sure I own less than 2 shares. It's called Starter Depot in Germany. So we have a real portfolio with real money we invest in, and each month we buy tiny pieces of the same stock again and again. It's called Sparplan, Aktiensparplan in Germany.
Okay.
And you buy little fractions, little parts.
Yes.
of a stock, especially if it is expensive as Apple is. But Apple is going to become much less expensive very soon at the end of the month. Yes. Yeah. Do you know what's going on?
They've got a stock split coming. They are going to split 4-1.
Okay. And then all the capital gains are gone, or what will happen then?
It doesn't change the market capitalization. The total market cap does not change. It just, like right now, what was that stock price?
400, close to 5.
Almost 500. Okay, so let's say it was 400, just to make the math easier. Instead of having 1 share at 400, you will now have 4 shares at 100 each. So it doesn't change the company. It doesn't change the amount of value that you have. It just changes the number of shares that you have. And honestly, what this does primarily is to make it easier for people who don't have $400 to get into the stock.
Yeah. It's for people who don't know what is an Aktiensparplan outside of Germany.
Well, okay. You know what? A funny story here. Fractional shares, what you're talking about, is how I started investing. There was a company back in 2000 that called ShareBuilder. It was bought by ING, and then it was bought by Capital One. But at the very beginning, they started the idea that someone with $25 or $45 can get into a large stock like Microsoft, like Texas Instruments, without worrying about having to gather enough capital to buy a single share. So my first purchase was 0.45 of a share of Texas Instruments back in August of 2000.
And does it still exist in the Anglo-Saxon world? And
it does in some places. I know that Fidelity allows it. I know Robinhood is starting fractional shares, but not many others do. I
Okay.
wish. My own broker, E-Trade, does not allow that right now. Maybe,
And do you
they're looking at it, but they're not allowing it.
and do you really own this fractional share, or
Yes.
is it? Yes, you really own it.
Yes.
Okay. Here in Germany, Aktiensparplan or fractional shares are very popular, and it's getting more and more popular. And I think it's really a good idea
I think so
because
too.
it's like saving. It's just like saving money, except using it on or
Right.
how to say
What it allows is dollar cost averaging that
exactly.
really makes sense for smaller repetitious investments. So
Yeah,
if you
exactly.
only have $20 a week, extra out of your paycheck to be able to put into it, most places, most brokers, you have to save up to buy one share of a $200 stock by saving up for 10 weeks. Okay. If you've got fractional shares available, then you can put in that $20 directly into the stock each week, buying a fraction of the share of the stock. And as it goes up during that time, you get the gains. As it goes down, you're able to buy more shares. That's the advantage of dollar cost averaging.
Exactly. Each week is high frequency investing,
It
but
is.
we mostly do it each month.
Okay.
Exactly. Okay. So that was that was a little bit about fractional shares, and now we are leaving Apple and going to the second highlight of the week. Chad, huh? What's that?
That is Tesla.
Right, Tesla.
So Apple was doing a 4-to-1 or a 1-to-4 split. Tesla is doing a 1-to-5 split,
And
which
here,
isn't really going to help the smaller investors because look at the stock price. It's $2,000. So it's only going to be able to drop it down to what?
400
400?
something. 400 something, yes.
But still,
It's
it makes it easier.
really crazy what happened here, huh?
It is.
If in such a short time. So back
But
in
on your site in particular, bring up some of those fair value estimations for the next couple of years. It really changes the way the graph looks.
yeah. Especially this one, huh?
Yep.
Whee! So Tesla is completely undervalued. So it's funny that on end of June 2020 the fair value was $2,048, and currently the value of the real stock price is $2,049. So it comes in very close, but that's really a coincidence. Huh? That's really a coincidence.
It is. But look at the end of 2021. Look at the end of 2022.
2022, $23,500.
Yeah.
But please do not take this serious. Tesla is still speculative stock that's really looking into the glass ball,
Yeah.
and discounted cash flow model there is superior to what we are doing here, honestly, because Tesla is not a typical stock we analyze on dividend stocks cash. Typical stock is 3M, Altria, all these boring investments which are predictable. Tesla is not very predictable so far, but yes, Chad, it's very interesting. It's just at least it shows the range, what's possible. Let's give us the fair value based on operating cash flows, and this you see it tremendously differs from this fair value.
Yep.
Here the Tesla stock is overvalued, so it's only worth $820 in June 2020, and it's worth $1,140 at the end of the business year. And it takes till 21 for the stock to become closely fairly valued and then undervalued in 2020.
So the fair value based on adjusted price to earnings ratio cuts the difference between the two and gives a more reasonable estimation.
Yeah, yes.
In theory.
In theory, but you should be very careful when doing this. using this approach very careful. I always say that investing in hot stocks like Tesla, you need a story. You really need a positive scenario showing you why to invest in it, and use this scenario to always this scenario to know if your investment story is still intact or not.
So there's a couple different ways that this could go. Tesla could build a revenue stream that creates those valuation metrics in real life. They could start to really bring in a profit and start paying a dividend. Who knows? That would be cool. And so I was able to get one share of Tesla through fractional share investing in November of 2018. So I have one share of Tesla. I don't have any Apple. Torsten, you said that you had accumulated at least 1 point something share of Apple. Were you also able to get into Tesla?
Yeah. But this was a real buy, not a fractional buy. But I still don't own. Unfortunately, I don't own as much as Elon Musk. So
I don't think anybody does. I'm satisfied with my one share of Tesla, and it will soon be 5 shares, which is very cool.
Exactly. So that were the highlights of the last week. We just wanted to share it with you. And now, Chad, you will share your dividend success story with us.
Yeah, let's. First off, I want to respond to one of the comments. We will be getting to the comments after we finish what we've already prepared. I don't want anybody to think they're being left out, but I do see some comments and some questions about that. Let's see. Can you see that okay?
Maybe enlarge it still a little bit.
Okay, let me switch it back. And how's that? That's about as big as I can get it. So what I did is I looked through my portfolio, and E-Trade helps break it down in some ways and makes it annoying in other ways. This is a summary of some of the biggest gains that I've had. If you sort it by value, the most valuable stock that I have in any of my portfolio accounts is currently Microsoft at 6,500, and my total cost on that was 961.
Chad, I'm sure you can zoom in, or here on Google Sheets. Isn't there a zoom?
How's that? Is that better?
Now that's perfect. I think
good.
It's easier to read.
Cool. Thank you. So the change in value was 5,565, but we're dividend investors. So what we're really looking for is a good dividend yield. Current dividend yield for Microsoft is 0.96. But if I take what I bought, the quantity that I've got right now, which is about 30.6 shares, and I compare it to what my current yield on cost is, I didn't prepare the language, so this is kind of haphazard. But my current yield on cost on those 30 shares is 6.5%. And that's not the best that I'm getting. The best that I'm getting is this one, and that's Comcast. Let me actually sort it by current yield on cost to bring that up to the top. So this is Comcast. I'm going to make that visible like that. So the current yield for Comcast is 2.14% according to Seeking Alpha, but with what I've paid for it, my current yield on cost is 13.74%. I see a lot of comments in groups and on pages and things like that talking about how you can't get rich with a stock that only pays 0.96 or less than 1% share. Current yield doesn't mean that much if you hold shares for a long period of time. I started buying Microsoft in 2004, and I've been accumulating through dividend reinvestment, but I only made 3 purchases originally of Microsoft stock. My average cost is $31.38. that's a little different from what it is now. It's, what is it, at 300? Whatever it is. So my current yield on cost for those shares is 6.5%, but current yield is 0.96. There's a big difference. I mean, the difference is 5.5% between my yield on cost and the current yield. This is the number that I'm really interested in. How well is my investment performing, and how much am I getting from that investment, from my original investment dollar? So the other ones that I've got on this list besides Comcast and Microsoft are Texas Instruments, AT&T, which was one of my very first purchases. Texas Instruments is actually my first purchase. So these two I'm not getting rid of. I'm really happy with those. My yield on cost for Texas Instruments is 11.13. My yield on cost for AT&T is 7.92, which is not that much different from the current yield, but AT&T pays a decent dividend. They're a good, healthy income stock. So the other one is NEE, which is NextEra Energy, and I'm currently getting a yield on cost of 7.05% from that, from a renewable energy utility. I also wanted to include these two for Tesla and AMD. These are the top two non-dividend paying stocks that I have. So the dividend yield stuff doesn't matter, but the valuation change between what I bought and where it is now, it was pretty cool. I actually don't have Apple, so I didn't include it here.
Okay, that's all.
So I'm welcoming any. Whoa, let's get back to that. And
we already have some questions. Also,
okay.
Any thoughts on British American Tobacco and Altria? Altria, I will show. This is one of my example stocks. There's also one more question about Tesla. How much potential do you see until Battery Day? Battery Day, I think it's still it's in September.
They've pushed it back a couple times. They have some big announcements coming on what they're going to be able to do with their battery technology.
But that's very short-term lifter, so it's a little bit speculation. I don't give so much about these short-term events. It's not a part of my story why I invested in Tesla. I just believe that they are very successful. And they will be very successful. I made a video about this, why I'm not going to sell my stocks. I made this video, I think, about 4 or 6 weeks ago, when Tesla was already very expensive, but still cheaper than today.
There is a YouTube channel that I follow that follows Tesla endlessly. They've been putting out weekly videos for probably 2 years now. It's called Now You Know. And if you want to hear someone who is incredibly bullish about Tesla and Tesla stock and the technology and everything that they're doing, check out Now You Know on YouTube. They're a really good source for that level of information. And just fair warning, they are extremely bullish.
Okay, nice. I will check it out. Okay, should I show my
why don't you show yours?
Okay, I'm coming. So the first one is Altria. Some of you already mentioned it, and I will do a presentation here using dividend stocks cash. So what we need as dividend investors is patience until the dividend starts paying off and the dividend increases. You see that stock like Altria is not a stock to become rich very fast, but at least here you see the dividends and they steadily increase in the long run. And if you just buy the stock and hold it for some time, then you profit from this dividend growth. And that's exactly what happened to me, fortunately. So I bought this stock at the end of September. And now let's see here in the dividend turbo if it was a lucky buy or not. End of September 2008. So it's already some time ago, about 12 years ago. September 2008 is here. And dividend yield these days was 6%. Sounded high to me these days, but was it a lucky buy? No, it wasn't, because I haven't seen the financial crisis coming and the stock market crash. If I had bought Altria just 3 months later, I could have started with a dividend yield of more than 8%, but I started with 6% only. So I started here end of September. Let's go back here. So I started here. This red dot here, this is my entry point. And now we are here. What does that mean? It means that you can also see, by the way, what's happened with tobacco, these tremendous capital losses within the last 2 years. And anyway, for me, it was, in the long run, overall, still a good investment. And my yield on cost is 16%. You can see it here. I hope you can read it. It's big enough. 16%. This is yield on cost, and this is a new feature. It will go live to production tomorrow. Today you can't see it, your yield on cost, but we have just implemented it, and it's now. I show it to you, so it's a preview. 60% is the yield on cost. It means I always get each year 60% of my original investment, and I think this is really, really cool. And I calculated also how much I already covered from my original investment, and it's already 108%, which means before taxes, which means the dividends I accumulated during this time already surpass the investment I did within these 12 years. And this is really a nice story, I think. And it shows the power of dividend investing. And for many people, these stocks are not so interesting. Many people say, oh, it's only interesting for dividend income investors focusing on high dividend. And yes, it's true, but still, you can really get a nice overall yield. So my overall yield, I also calculated it, is 197%, always before taxes. So capital gains, including dividends, close to 200% within 12 years. Someone investing in Tesla will laugh at you with these numbers, but for dividend investors, I think this is really nice. And let's have a look at something else. Another stock of mine. It's Novodisk. Let's get it here. Novodisk. Here it is, and I will show you or tell you the numbers. Novodisk I bought back at the beginning of 2010 in January. So somewhere here. Somewhere here. And what is interesting is if you look here, I bought it here, and I bought the stock on an all-time high. So when Novodisk already seemed to be expensive, already these days the company was fine. You see here how the earnings increase, how the cash flows increase, how dividends regularly were increasing. So the stock already looked nice, but many people, that's always the problem. If a stock goes up like this, then are you still going to buy the stock? Yes or no? Many people tend to wait, and then maybe they wait too long because the stock always goes up and up and up. So I bought the stock at the end of January, and was it a good buy? It was somewhere here at the end of January 2010, and the dividend yield these days was 1.6% only 1.6%. So it's really sluggish, and also not a very good buy. You see here that the dividend yield went down because the stock price went up. If I bought just some months earlier, it would have been close to 2%, and now when I bought it, only 1.6%. But still, in the long run, I think I was lucky because, as you can see here, the stock price went up with some headaches here in 2016, but overall, the stock price went up. And my yield on cost today, so 1.6% these days, yield on cost today is 11.7%. And that's really cool. So each year I get close to 12% of my original investment back, and it's still increasing. And it's really cool story. And Novodisk, contrary to Altria, is not a high dividend stock. It has never been a high dividend stock, but still you can see the power of dividend growth, which boosts your dividend yield. And the yield on cost of Novodisk is double digit. So I think it's really cool. And if I calculate the overall yield I got, including capital gains, here, nice capital gains, I come to about 540%, and I think that's really nice. So I'm just looking if you have some comments to answer here. Thank you for this.
I'm preparing right now to show my own stocks on dividendstocks.cash, and I'm sorry.
Okay. I still have one more stock to show, and it's Microsoft, which is also Microsoft is a third animal. I showed Altria, which is a dividend income stock, or a stock for dividend income investors. I showed Novodisk, which is not a stock for dividend income investors, but I think already more kind of growth stock. At least it was these days. And Microsoft, it made a transformation, because when I bought Microsoft, it was still a dinosaur, and the overall yield was very nice. You can see it here, but I must look when I bought the stock. I wrote it. I bought the stock not so long ago. This is a special dividend. Let's get rid of this. I bought the stock in 2015 in August. So I bought the stock here, and I got a dividend yield which came close to 3%, and that was really a lucky buy. So, and now, today, the dividend yield of Microsoft is just, it's below 1%, because the stock price really rocketed. And my yield on cost for Microsoft is, I will show you. Stop here, we need to go here. And here you see the dividend growth. It's also very nice, but let's get rid of this. So in 2015, in August, so it's here, somewhere here, exactly. And then connect these dots, and you see it here. And the yield on cost is 4.7%. So it's well below, it's not double digit, it's well below Altria and Novodisk, but way above 1% you get today. And the combination of high capital gains and dividend increases. So here you see, by the way, you see the dividend increases, double-digit dividend increases in first years, and then, okay, single-digit, but very high, 8%, 9%, and again 10%. So this is really cool, and the overall yield I was happily able to receive is 400 60%, so less than Novo Nordisk. But Novo Nordisk I bought back in 2010, and Microsoft I just bought 5 years ago. And it was a lucky strike, obviously, and I'm really happy for that.
Cool.
Okay.
All
yeah.
right.
Chat.
So let me show my 4 stocks, the top 4 here: Comcast, Texas Instruments, AT&T, and Microsoft. I'm going to skip NEE for now because it's too recent. But so for Comcast, I originally bought it way back in March of 2001, somewhere around this quick dip right here. And it is currently valued at 4307, which is a nice upswing, but I had to weather a lot of down years before it got back up to where I bought it from on a regular basis, and then the skyrocket from there. So I don't have the preview. This is the live dividend stocks.cash, but still, that's not bad for capital gains and dividends. So a total yield of 279.8% according to that estimate of where I bought it. This also does not include all the dividend reinvestment that happens, but this is fine for estimating this sort of stuff. So this was nice. The next one was Microsoft. And you had started, I think you said, started here around 2015.
Exactly.
I started way back in 2004. So my gains started back here, and this rocket ship, I weathered a couple more years during the last of the aughts and the beginning of this decade, and then it started going up, and it just kept going like crazy. So that total yield, 794.5, that's not bad.
You started investing when Bill Gates was still steering the company.
Oh yes, I wish I had bought it in the 1990s. That I wish I'd put money into it then. I had an opportunity and I didn't do it, and that's one of my biggest regrets. Let's see. The next one I wanted to show is Texas Instruments. Again, I started buying it way back in 2000. And I had to weather a number of years before it finally got back up to what it was sometime in 2014. And then it's gone up from there. So total return on that, 2,315%. So that's not horrible. The next one is interesting, AT&T. I bought it starting here around the same time. This is about as far back as you go.
In 2000?
In 2000. Okay. The stock value has gone down since then because it was at $55 at that point. But it's still positive, and it's still positive because of the dividends. My total return is still positive. It overcame the drop in capital gains, and it's hopefully going to stay steady or even grow from here. But the dividends for AT&T made it worth holding the whole time. So those are the 4 stocks on my list here. Do you have NEE? You know what? Never mind. Let's actually go for some of the comments here.
Next area, energy. Yes, I have. But this AT&T example is really interesting because it shows the power of dividends in a way I didn't think about. Because it shows that it can even overcompensate massive or really tremendous capital losses. Huh?
Yeah. And like I said, for AT&T, I spent about $2,000 on it, and the value is currently higher than that. So I have had a gain compared to what I originally put into it. And I'm still getting more yield on cost than the current yield by almost a full percent, 0.91. So yeah, AT&T is a healthy income stock. It always has been, and it will be going forward. I'm not putting anything more into it other than dividend reinvestment.
Mhm.
But the cool thing about that is the dividends that I receive help me buy at least one, maybe even 2 shares every single year. So my number of shares is going up because of dividend reinvestment.
Nice. Okay, your entry point at the end of 2000 was very unlucky with the
Yeah,
burst of the dot-com bubble. It was not possible to see what's coming. Huh?
no, it wasn't. And this
Uh-huh.
was the run up to the Great Recession, which happened right about here, and
Mhm.
then it's sort of recovered, but they've been going sort of flat,
Mhm.
sort of sideways. But that's
By
okay.
by the way, we may on our blog, both in English and German, we have on Dividend Stocks Cash and Aktienwinner.net, we have analysis about AT&T and about Microsoft also, and about really, meanwhile, a bunch of other interesting dividend stocks as well. So it's free. You can just read it whenever you want.
Cool.
Mhm.
All right. So we had a question from Proud Ottoman. Thoughts on Johnson & Johnson? So let's bring up J&J.
Should I? Because with my preview, I don't know if it's useful. Okay, you do it.
Got it.
Yeah.
All right. Let's go back to now let's look at the last 10 years. So I'm not sure when you bought it, but the current main thing that I look at, or the first thing that catches my eye, is the valuations, the estimates for valuations, and it is currently overvalued, like everything else in the market is today. But we don't invest for today, we invest for tomorrow. And the estimates by the industry experts say that Johnson & Johnson will grow back their revenue streams, their operating cash flow, and we'll see an increase. So if we take the middle, which is based on price to cash, then we might see a gain. Not much, 77 out of 1,000, but we'll also see dividends over those 2 years. J&J is a nice dividend stock. Let's see, Seeking Alpha. Let's bring up so we can see the basics on dividends. So the current yield is 2.64. They pay just over $1 per share on a quarterly basis. They've been growing their dividend for 57 years. Let's take a look at that growth. That's nice growth.
58 years, according to Dividend Stocks Cash.
Yeah.
1 year more, yes.
I don't think Seeking Alpha updates automatically. So let's look at full momentum. They're basically keeping up with the S&P. If we use the S&P 500 as a benchmark, then they've been keeping up with it the whole time.
Mhm.
But if you look at it going back to the beginning of their data in 1990, they've actually been exceeding it. So if we
Okay.
want to look at one more thing here, and then we'll go back to your site. The yield on cost is what we've been talking about.
Uh-huh.
So the yield on cost compared to right now, which I said was about 2.64, going back 5 years is 4.05. Going back 10 years, it's almost 7%. Going back 20, even higher. And this is the real holy grail. So bumped up to 60% if you had bought it in 1990. This is what holding a stock does. For anybody who bought it way back here, they're getting that kind of a yield on cost on whatever they were able to invest back then in 1990.
What is the yield on cost for 10 years? Johnson & Johnson?
For 10 years, looks like it's about 6.86%.
Okay, I have 6.7%. I was just going to challenge Seeking Alpha. So we have the same data, basically.
Yep.
Mm-hmm. Okay,
All right,
nice.
so let's switch over to you so you can do a more detailed valuation of this.
More detailed, don't know, but I just did the same thing on parallel what Chat did. Not according to Seeking Alpha, but according to this one, because I also, disclaimer first, I own Johnson & Johnson, so I'm invested in this company, and I'm not unhappy about. It's a very solid dividend payer, and if I want to evaluate the fair value, if the stock price is, or if the stock is expensive or not right now, then I would use the adjusted earnings, the operating cash flows, and dividends. Also nice to know, not the fair value based on reported earnings, because that's a little bit bumpy. It goes more up and down like the other metrics here. And if I look at this, and you see that the stock sometimes is overvalued, sometimes it's undervalued, but most of the time it was either fairly valued, rarely undervalued, and more often overvalued. Undervalued last time it was during the Corona crash. Here there was an occasion to buy the stock with a discount, of course. I think it's not a surprise right now. This, by the way, this is a 6.7% yield on cost, which is the same as Seeking Alpha told us. So it gets rid of this, then we see this a little bit better. And now we see the effects of the Corona crisis, the earnings and cash flows right now going down. This is the latest data we have from June this year. So this brand new data, and there won't happen very much till the end of the business year, probably. And then there will be the recovery. And when the recovery really comes, as we all hope and as analysts predict, then the stock is back fairly valued. So right now we have this artificial drop in fair values due to Corona. But when things come back as usual, Johnson & Johnson is not expensive stock anymore, I think. So it looks more expensive to me right now than it really is. This is my conclusion. And we still get nice dividend. It's less than the average, but it's now 3.6%. That's already nice. And it's higher than in some time ago, where the dividend yield was as low as 2.35%. So it's not so low as for some other stocks, especially the high-tech stocks like Microsoft or Apple. So I think it's still okay. It's not completely overvalued, Johnson & Johnson. Do you agree, Chad? Johnson & Johnson is not completely overvalued?
Not completely.
Okay.
If you look at the valuations, they might be a little overvalued right now, but like I said, we don't invest for today, we invest for tomorrow. And over the next couple of years, as the recovery continues, they'll get back on track, and we'll see some gains. At least according to the estimates.
There is a question which about Gillette Science. Already last week, someone asked about Gillette Science. Is this your animal? Is this your cat? Huh?
Yes.
Do you want to present it to us?
Well,
we already saw its tail.
Come here, you. This is Gypsy.
This is a dividend cat.
Live stream cat. All right, you want down. There we go.
Okay.
Okay. So Gillette Sciences.
Okay. Maybe we should also make a disclaimer. So if you ask very specific questions about the potential of company X because of the event Y or something like that, battery day or remdesivir or anything else, of course, very often we don't know, because you caught us on surprise. We can't know anything.
Right.
But maybe we can still look or have a look at the fundamentals, of course, and maybe we still know something about it by accident.
Well, the advantage is that your site brings in the estimates from experts that do pay attention to all of that information.
Exactly.
So here's Gillette Sciences, I think. No, this is IBM. Where I had it. Is this it? There they go. There we go. So this is Gillette Sciences. And this was an interesting drop. I want to show this really quick. The green is earnings per share. And they had a massive crash thanks to the Corona crash in earnings per share, but adjusted not too badly. But they're also rather flat here. So if you look at the estimates for fair value based on adjusted earnings per share, you can see that's pretty flat. Cash flow, yes.
I think it was a write-off, huh? This drop in reported earnings.
Was it?
Very probable.
Very probable.
I will have a look at it.
Yeah,
you just continue, and maybe I find out, maybe not. We will see.
So dividends, which started for Gillette back in 2015, they've been on a steady uprise, and estimates are that that will continue. So let's look at fair value. This is a little bit disconcerting. That's the wrong word. It's a little off, so you can't quite trust what the fair value is going to be just because of dividends, but it's an interesting calculation to see. And most important for me is you can see that the estimates are that they will continue to raise their dividend each year. Looks like they've been doing it every quarter for quite a while, since 2016 or so. So that will probably continue, especially if their operating cash flow continues to grow back to what it was, which estimates look like it looks like they think it will. So if we bought it here, and let's take the middle of the different, that's about the same. So we might see a capital gain according to those estimates of 303, plus they are paying a dividend, a growing dividend. So maybe we'll see a return of 40%. We'll just have to see. I don't know that much about Gillette. I just look at the graphs. They have not been growing their price since 2015, so it's not that high on my ranking list.
To me, it's a speculative stock. It's biotech. Biotech is often a little bit speculative because you never know what they are just going to develop in their laboratories, if they will make money with that or not. And meanwhile, I found something on FactSet. So FactSet is our data provider, and here you have the earnings per share. It's GAAP. These are the reported earnings. On dividend, stocks, cash is what you see in green, and then we have these non-GAAP numbers, and these are the numbers we say, or we call adjusted earnings. And then you have this big thing here. You see earnings per share are negative. This is the latest data we have from June, so anything brand new. And here we have $3.58 costs related to acquisition expenses, and there's a company IPR and D. I really don't know about the company. I don't know about the event, but I think it is a write-off. I imagine it is a write-off. I guess it is a write-off on goodwill, probably.
Okay.
So you see, these are extraordinary expenses, and that's the reason why the earnings per share are negative.
Okay.
So it's not it's a hot stock to me. So it's not something I'm investing. If I'm going for pharma stocks, I'm investing in so boring stocks like Johnson & Johnson, and not. I still have Johnson & Johnson here. Gillette Science, too hot for me.
So we have a special guest in the audience, Jason from JMac Investing. He's asking if we can take a look at CDW. So let's take a look at CDW. CDW is an information technology sector, technology distributor, corporate, small business, and public distribution. Let's take a look.
Mm-hmm.
On Seeking Alpha, momentum is really nice. It's not quite 10 years old on the stock market, but it's been beating the S&P really well. Total return, is this a dividend stock? Probably. 1.37%, that's not terrible. It's been growing the dividend most of the time that it's been, since the very beginning. This is the beginning of the dividend growth.
Mm-hmm.
Dividend history, they paid quarterly. Looks like they raise their dividend every single year. And it looks like the next one's going to be an increase. Let's see. Do they have that announced yet?
Does Seeking Alpha give you the
Payable.
estimates?
They do, but you've got to drill down.
Okay.
So let's bring it up on, is this it? No, that's Johnson & Johnson. Where's my CW? There it is. CDW, got it.
Great.
So right now, it's not as overvalued as a lot of the other stocks that we've been looking at. So they may be struggling a little bit. If we just look at fair value based on earnings per share, we'll see a little bit of a gain. But it looks like this is a long play.
Exactly. It's really a nice stock. I had this CDW on my radar. Maybe I will edit this stock to my watch list, because I also checked out the fundamentals very fast. And you can, with a little practice, you see very fast within a glance if the company is promising or not. And this really looks like a very promising company in my point of view. But of course, I need to check out first what they are really doing, looking at their business model. And here you see, yes, they started paying dividends in 2013. And here you see really nice, predictable dividend increases. And even the current dividend yield is close to all-time high with 0.4%. So before it was always lower, and now it's close to all-time high, except during the Corona crash, of course, it was a little bit higher. It came close to 1.5%. And their dividend increases, I guess they are really high. Look at that. Look at these numbers. The dividend increases. This company increases dividends each year by around 50%, 400%. Okay, they started paying dividends, so that's not, you can't use that number. 55, 55, 43, 35, 37, 0, 10 to 5. Why 0? I don't know.
So Seeking Alpha has similar numbers on that. Let's take a look, because for the dividend growth, year on year, between 2018 and 2019, they increased their dividend 36.76%.
Exactly what I have here, yeah, 36.6%.
Yep. 3-year growth at 37, 5-year growth at 45. If they can continue, then this is a great stock. While you're presenting more, I'm going to check my TGI list, because that needs to be on it.
Here we can also see the dividend benchmark. Ooh, you look at that. Now 1.37%, and if they continue like this, that's the yield on cost here. And you see it goes up, and then someday it gets double digit. Okay, 16 years from now.
Wow.
I calculated it very carefully here. Very defensive dividend growth here.
Okay.
But still it looks nice, I think. It doesn't, Tencent even looks nicer if you look at Tencent as benchmark. I think, CDV outclasses Tencent.
Wow.
Also as dividend stock, because Tencent has really high dynamic dividend growth, but CDV is even better. So nice stock. Thanks, JMac. They do consulting, he says, for big corporations and government agencies. So I will have a look at that, and maybe I will even analyze the stock and present it to the audience in greater detail. Great.
Okay.
Thanks for the comment.
All
Okay,
right.
thoughts on Tencent. I haven't read that one. I didn't read it, and let's see. Someone already made a question about Tencent. I'm worried about investing in China. Political risk. Okay, basically it's nothing new except after Trump became president. Maybe with all this trade dispute, it's a little bit more on the agenda as it was before. Chet, you are an American. What do you think about the political risk of investing in China?
I don't think that investors should. I mean, all right, I don't support Trump, but I'm seeing things from a long-term game perspective, and I see China continuing to rise significantly over the next couple of years, over the next decade. I mean, they are equals with the U.S., with Russia, with Europe, and in a lot of ways, they are surpassing the economic growth of the big dogs. There are always questions about the accuracy of data and information coming out of China, but the growth for Tencent that we have seen has been pretty darn significant. You have it. Let me bring it up, and then I'll.
Yeah, I will.
You got it? Yeah, go ahead.
And then have a look at it. Here are the fundamentals. So you really
Look at the growth. I mean,
it's still okay.
And we're not going to see it go down. I mean, the dip in operating cash flow that you can see in the top graph right there takes a small dip because of the Corona crash, but then it jumps right back up. And these are industry expert estimates. And the earnings per share is just going to continue to go up. It didn't even see a dip. And that's just the growth of the Chinese economy. If there are questions on whether it can grow as much as other stocks, that's a decent discussion. But political differences, I don't think we're going to go to war. I really hope that we will not repeat the mistakes of the 20th century in the 21st century. So I don't think that we're going to see that go into a war situation, and I don't want to. Nobody does on either side. As for a strict investment portfolio perspective, Tencent is an incredible stock. It's an incredible company, and they are going to continue to grow. If you can get around that political risk, then you can invest and you might see some decent gains.
Regarding China, I think people are uncertain because of two major issues. One issue is the ADR. So people are maybe afraid that the IDRs get banned from the American exchanges. And then what happens with your stocks? This might be one thing people are afraid of. And the second thing is mostly issues directly related to the company. For example, regarding Tencent, we have a WeChat, which might be banned, or is it already banned from the US? So that the Play Store and all these things you can't download a WeChat anymore for US consumers, and this also hurts the prospectus or the performance of Tencent.
Right.
In this case, not very much. I was reading not very much. I remember less than 2% of revenues made in the US and
right.
all
it's
these
not
things.
Hurt the company. We can do all the banning that we want of platforms like that in the United States, but with the small amount of business that they're getting in the United States, it's not going to affect their revenue streams. It's not going to affect their earnings per share. It is a valid concern, but the thing is, WeChat and all of the other things already have equivalents in the United States that have the vast majority of the market share.
Exactly.
I wasn't prepared for a political discussion.
Okay, it's a little bit the audience telling us about what to talk. Okay, but I
That's
think
great.
we are already well advanced right now.
Yep.
There are no new questions coming in, and we already passed 1 hour.
Yes, it has.
So maybe we say goodbye to the audience for this time and welcome them back 1 week from now.
So I will repeat the same thing that I did last week. If you have ideas on what we can do a stream on big topics or stocks that you want us to look at in detail, let us know way ahead of time. Send a message to the chat here in this on this video. Send a message to our pages. You can contact us directly to give us ideas. We'd love to hear more ideas from you.
Exactly. Okay, so thanks for watching. See you next week and good investments. Bye-bye.
Good luck.